What's going on out there? It's Thursday, September 15th. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. So, Daniel Creech, 3 days in a row, joining us. You okay? You feel all right?
Yeah, it's absolutely. It's been one of the better weeks in a long time. 1, 2, 3. Every day is Wednesday here, Frank at Curzio Research.
Yeah, well, I mean, usually I reserve Thursdays for interviews. And for this week with the Fed and what they're doing, I thought it was relevant where it didn't matter what anybody said, who I was bringing on. I really wanted to talk to you about it because what the Fed says and what they do are usually two different things. But they basically said exactly what they're going to do. I like that they came out and said yesterday that they're going to be data dependent, but also what was a shock to the system, which is why the stocks, the Dow went up 300 points at first and came back down, was he raised rates, like his forecast for where rates will be next year from, people looking at 4.25 to, 4.5, 4.6%. And he said they're going to stay there for the entire year next year. Which is considerable. And then I think people started digesting that and then said, okay, wait, that's just not good. It's just not a good long-term scenario. But what did you get from, what was your takeaway from yesterday's meeting?
I was surprised that the market didn't sell off more and it didn't sell off quicker. So when I was looking at this, at 2 o'clock Eastern time is when the announcement came out. They bumped 75 basis points. Markets were a little volatile. At 2:30 when Powell's Q&A started, at 2:30 kind of makes his statement and then the Q&A starts. If I remember correctly, markets were basically flat, and they were going back and forth on his comments. I couldn't believe the very first question he took, and no disrespect to the reporter, whoever asked it, it didn't matter. What he said was, before I take your question, I'll answer your question. Nothing, and I'm paraphrasing here, he says, nothing has changed since Jackson Hole. I thought, boom, there it is. That's going to just hit the sell button, because Jackson Hole calls such a, he used the word pain and all that kind of stuff. I was a little surprised that how terrible is it to say the stocks fell over 1.5% across the board. And I was surprised just based on his tone, because what he told you is he was a politician. He tried to, walk a thin line.
Go both ways, yeah.
But the only thing that I took away from that is, like you just pointed to, the increase in federal funds rate towards the end of this year and higher for longer. That this sucks for our job because we want to, entertain and educate people. But that is not good for the stock market. I mean, that is not a good sign to the end of the year. At least we have some sense and what the road looks like to the end of the year. But overall, the path to the least resistance is still lower for markets.
Yeah, I mean, I wasn't surprised at all that it didn't go down further. That was my thesis for saying it could go up 1,000 points, because they even said worse than expected. And you saw a 300-point pop. And then it came off as people started digesting it, because I think that was a surprise. So a lot of the negative and the Jackson Hole, I mean, everyone on TV, that I figured that was factored into stocks. What wasn't really factored in is him going a little bit higher on that rate. And, from 4.25 to over 4.5%, 4.6%, that's what they're predicting. But that's why I wasn't so surprised. That's why I said it's a good trade where you could see that happen, because any positive is just so much negative. That's what you're seeing right now. I mean, investors haven't been more bullish than this almost ever, or more bearish than almost ever, which normally signals, and there's, the sentiment guys and the traders are saying, the year after, when we've seen it this negative, it goes up 35%, 75%. And they're like, and they joke around and they're sarcastic saying, this time is different. This time is different. It is different. It's not the same. Okay. If you compare those other periods when we've seen this, we didn't have this in the face of rising interest rates with inflation back in the 1980s. And I hate when we see that, when people compare different time frames and they're saying, well, the P ratio, that's what we did. How many bears have gotten it wrong? And I'm going to cover this in a minute because it's very important. From 2010 to 2019, 20 into COVID, saying that, the P ratio is too high. Historically, we've never had rates at zero for almost 10 straight years, which promotes money into the system. It promotes growth. It makes you're an idiot if you keep your money in savings. That's the way the government made it. It's a different scenario. To compare that to 10 years, 30 years, and 50 years, it is different this time. It is different. We're in uncharted territory. And if you want proof of this, Daniel, this is what you have to realize of what happened, okay? It's important for you to realize this. And you're looking at Powell last year. He's been doing this for 40 years, Daniel. 40 years. Studying economics, theories, pretty much his whole entire life. Studying the boom and bust market, every recession, depressions. He studied it all. That's what this guy did. That's what you have the most head of the most powerful institution in the world that could destroy world economies or make them grow based on your policies, right? That's how you got there, right? So last year, based on your 40 years of experience, everything that you know, it told you that when inflation was at 5%, it was going to be transitory. That was your thesis on everything you've studied your entire life. And that's okay. You get it wrong, we get it wrong, and then we adjust. Okay, so you were wrong, and that's okay. That's the past. We know it wasn't transitory. Last year, we had zero rates. You were aggressively buying bonds. You just said that. It was funny, right? They mentioned that Wall Street Journal today.
Yep.
You pointed that out, right? We were saying that aggressively buying bonds. This is last year, a year ago, right, Jack Stoll? And you suggested, again, based on the 40 years of experience, 40 plus years of experience, that inflation is going to be short-lived. 1 year later, we fast forward to today, you just raised rates by the fastest pace in close to 4 decades. You're going to raise them by another 1.5% over the next 5 to 6 months to 4.5%. You're about to aggressively shrink your balance sheet, which is $9 trillion, by over $1 trillion annually, taking money out of the system. And now you no longer think inflation is transitory. Think about that for a minute, because you thought inflation was transitory with zero rates. Now we're going well over 4%, and you totally threw that thesis, again, which is formed from 40 years of studying economics, out the window. So if you look at this analysis, Powell is basically operating 100% in the dark. He's throwing everything that he learned for 40 years out the window, putting him in a position that he's not really qualified for. Because if you're telling me that you thought inflation was transitory when interest rates are zero and you were buying bonds, and now you're shrinking your balance sheet, you're aggressively raising rates by the fastest pace in 40 freaking years, and we're already there, and you're seeing this. I mean, you're seeing across the board where semis are now warning, companies are warning, industrials are warning. It's not just FedEx and Ford and people looking at those two companies because those are big names. We follow all the companies. They're warning. 70% of these CEOs think of recessions coming if we're not in one. We'll get to that in a minute. But this about face, it's not like Nick Saban, which was one of the greatest coaching moves, I think, in history. He was an Alabama coach. He switched quarterbacks in the second half in the 2018 college football championship. So Jalen Hurts to Tua, which is great because those two guys are doing great now. But it was insane. It was an insane move because Hurts was 25-2 as a starter. He just had a bad first half, but he saw they didn't have it, right? This isn't like one of those, about faces. I mean, this would be more like Saban, like telling his entire team to sit down and taking 11 fans and saying, okay, here, you guys play Georgia, we got a better shot. That's how far, I mean, if you think about that of where we are, of how much he's going to overshoot, if you really thought inflation was transitory with zero rates and you're buying bonds, and now where we are right now, you're saying that it's no way close to transitory, meaning that you're going to stay well over 4% for the entire year next year? I mean, you know what the adjustment is going to be for us? I mean, it's insane when you think about it. And by the way, I just think it's hilarious. Dan, what's your definition of recession? What is a recession? Do you know? I don't know. I've been doing this for 30 years. I have no fucking clue what a recession is. What's a recession?
There we go. We couldn't even, Frank.
No, but I'm going to get fired up. If you don't like it,
I like it.
I'm trying to help you guys. If you can't ignore a curse word, ignore it. But this is what happens when New Yorkers get fired up. So go ahead. Tell me what a recession is. You define it for me because I don't know. I have no idea what a recession is.
Well, I have an old soul, Frank. So despite my age, I'm going to go with the typical definition of 2 quarters of negative growth.
Okay, that's the definition. If you open up, I
feel like you're luring me into something.
Webster's. No, I'm trying to figure it out because that's not defined as a recession because unemployment is good. But you know what's defined is 5 out of 6 quarters of negative GDP. Is that going to be a recession? Because that's where we're going. That's where we're definitely going. Yeah. I mean, if you take the 2 that were just negative, there's a good shot that this is going to be negative. This might be the only positive quarter we see. And the next 3 are going to be negative. At least negative. But that's not defined as a recession anymore. Why? Because unemployment, it's so low. It's so low. We're doing great out there. The economy's great, right? So the president says the economy's awesome right now. Well, when you look at the labor force, you always want to look at data and look more into it. Because the number of persons not in the labor force who currently want a job, you notice how they define that where it's kind of confusing, right? So it declined by 360,000 to 5.5 million in August, right? So this measure remains above its February 2020 levels. That's reported in the last unemployment number. And this is for August. So these individuals were not counted as unemployed because they were not actively looking for work during the 4 weeks preceding that number. That's 5.5 million people that that don't have a job but are not in the unemployment figures. Now, put that in perspective. Right now, our rate is 3.7%, which accounts for about 6 million people that are unemployed. That gets us 3.7%. But 5.5 million other people are not part of that because they're not looking for a job. They could be working off the books. They could just be like, listen, I'm done. But you can't blame them because you were handing them freaking checks directly for not working, telling them don't work. It's fine. You guys are okay. All right. So when you're looking at the numbers and you're looking at the data and how they calculate it, I also broke down how the CPI is not going to come down in a year. If that's your gauge, if that's really your gauge that you're looking at, since rental income is 30%, and you look at shelter at 30% of that index, that's not coming down anytime soon. It's just not coming down anytime soon. So if that's your gauge, the Fed is serious and they're going to continue to raise rates. But on the recession front, you'd have to say we're in a global recession, but we're not. But even if unemployment, if you take that, an unemployment rate would be what? You're not going to take all 5 million of those people, but even half of them, you're looking at an unemployment rate above 5%, 5.5%. And less participation rate. So 3.6 is more like 4.6 now compared to, again, we have to adjust this stuff as more people come out of the workforce. Nobody wants to look at the data. They just look at a number and say, I don't even care how it's calculated. Oh, you asked 3 people if the market's going to go higher and that's it. 100% believe the market's going higher. You look at the survey, it's like they surveyed 4 people. And who are these 4 people? I don't even know their names. They're just on the street. They don't even, who knows? I don't even know if they're legal immigrants or not. I have no idea, right? That's just 4 people we surveyed. You don't know. You got to look at the data. But when you look at the data and you look at how everything's calculated, it's really insane here. But the definition is 2 straight quarters of negative GDP. If that's not good enough, wait till we see earnings because we're going to get negative earnings quarter. It's X energy. And I'm not just cherry picking energy. I mean, energy's profits were up like 1,000% or something. It's like some crazy number. It's like 600 something percent. And it accounts for a small percent. Now, it used to be 2%. Now it's 4%. But strip out energy and you look at, I think it's the other 10 sectors of the S&P 500, and you're seeing earnings year over year fell 4%. That's a big number. But the recession thing, Daniel, I'm trying hard to figure out how it's defined.
And to your point, earnings have come down. I think, and not to put these words in your mouth or make this argument for you, but earnings have got to continue to come down. So before third quarter results start getting reported, we have to see some revisions lower, don't you think?
We're seeing revisions lower, right?
It's going to continue. I mean, they're not all set right now. I mean, you'll probably see more companies possibly warn going into that quarter, et cetera. What I do think, the reason I think the market, and again, I don't say this lightly, the only reason the market went down around 2% yesterday was because at least he did, Fed Chair Powell, acknowledge that some things were slowing. He mentioned housing a couple times. He talked about how it's not enough and how the Fed needs to see more signs and more data to back up the slowing of the economy and everything like that. One of the quotes that he said, Frank, which again, I thought would cause more selling pressure. He says, no one knows whether this process will lead to a recession or if so, how significant that recession will be. This was in back and forth questions on regarding, hey, to your point, they keep pointing to low unemployment. The Fed, I think, Frank, is in no doubt going to just raise until something breaks. To your point, going into an election year, you have a slowing economy, you have a higher interest rates, you have inflation at 40-year highs, and now you're going to have, Jerome Powell yesterday, reading between the lines, said that they have to push up unemployment even higher. They are okay with that. One of the questions, I think, even tried to break it down into numbers and said, are you okay with another million people if the unemployment rises to XYZ, that's another million jobs lost. Are you okay with that? Essentially, he is. And he has to be because they are hell-bent on saying we have to get this. I was looking for the transcript yesterday, Frank. He's committed. I mean, if he follows through with what he says, then we really need to be defensive because he's simply saying we cannot fail. We will get the job done. We have the tools necessary. We will stay on the track to do this. That means paying for stocks excessively in the short term. But to your point, something's going to break. Recession or depression is going to get thrown around. That's when they'll have to pivot, and it'll be forced, in my opinion, which means it's going to be volatile.
So let me ask you this question. We didn't rehearse this at all, okay?
I like this.
What is your thesis for buying stocks right now?
Oh, there's very little to buy right now. It's more of a build a shopping list.
But even if you look, it's build a shopping list.
Yeah.
But even people who are bullish, I mean, what are they saying right now, right? It's like, it's if you're looking for a reason to buy stocks, and you look around, it's like you said, it's hard. But the thesis, any bull thesis right now, what does it revolve around? It revolves around
the Fed pivoting.
Yeah, the Fed pivot, which we know that, which
at some point they're going to,
they're not
exactly,
going to pivot, right? I was hoping that pivot doesn't mean that you're lowering rates. A pivot can mean like, all right, we're just going to slow down. They're not slowing down, right? So that pivot's gone. That's out of the equation. But right now, the reason to buy stocks, the only reason, right? You could say sentiment indicators and trading indicators and stuff like that, and I get it, right? It's most bearish conditions, and you might see a pop again. That's a trading opportunity, which is probably going to be sold off just like we just saw with this recent market because you got the Fed there. And the Fed's raising rates and doing everything, whatever, buying and selling bonds. So anyway, you're looking at the thesis being that stocks have come down and they're cheaper.
Mm-hmm.
That's the thesis of anyone right now. Other than that, you tell me someone else is buying stocks, a reason why they're buying stocks. And they could say sentiment indicators. Again, I get it, trading opportunities, but those sentiment indicators were negative for the past 2 weeks as this market has come down tremendously. It keeps coming down before this Fed meeting and even now. That's why I said we could see a 1,000-point increase if the Fed just hints at anything positive, just a tiny bit positive, which he kind of didn't, and wound up going down. So if that's your thesis, stocks are getting cheaper, stocks are all about earnings. Earnings drive prices. That's true no matter what year, whatever. If you're seeing earnings growing, if you're seeing growth in the economy, that drives stock prices. Okay, and right now, what are we doing? We're raising rates. So rates are going to get incredibly higher, which is going to crush world economies. It's already doing that right now, which means that when you're raising rates and everybody else is in a much shittier position than us, it means they're going to continue to pour into the dollar from here. Okay, and that's one major problem, one massive headwind for earnings. Because if you look at earnings, how much does a dollar hurt? It hurts a lot. And you're looking at 29% of the profits from the S&P 500 companies come from overseas. If you look up Google, that's what it's going to say. Again, for guys like me, we break down the data. So you're like, we'll just not worry about those companies within the S&P 500 that have a lot of exposure. But let's break it down a little bit. Because if you're looking at technology companies, tech companies they rake in 60% of their revenue from overseas. Well, tech is still by far the largest weight in the major indices. Apple, Microsoft, Google, the FANGs, throw in NVIDIA, AMD. And tech accounts for 30% weighting in the S&P 500, right? So to put that in perspective, this is higher weighting than healthcare and consumer discretionary combined. So they're the ones that are getting hit the most, and those are the ones that are going to see earnings come down, which is a pretty big deal because you're going to see the dollar go higher. And you might say, well, it's not really that much. It's not going to be that crazy. It is going to be that crazy. And if you think I'm crazy, just look at some of the companies, the technology companies, and even some of the healthcare companies. You look at IBM, they said the climbing dollar last quarter could slash revenue by $3.5 billion. Netflix said the dollar's performance had erased $339 million in profits. It's stronger now from when they warned, by the way. Johnson & Johnson, the stronger dollar could eat away $4 billion in sales. All right, so if you think the dollar's not a big deal, think again, because that's one of the headwinds that really not so many people are factoring in when I look at the analyst estimates, right? Because analysts are coming down, the issue ever slow the economy, but it's also the dollar. And these companies don't say anything when, the dollar's weaker and their profits are higher. But now you're going to see X currency. That's what they're going to say. X currency, this is how much we earn. That's one of the things. The other thing, too, and by the way, financials and industrials account for another 20% of the index. And those are the other two sectors that have a lot of exposure overseas. So the largest sectors that count for the largest weighting in S&P 500 have the most exposure to the rising dollar and most exposure to profits overseas, which means those earnings are going to get hit the hardest. And when they do, that's going to result in the S&P 500 falling a lot more than you just saying, well, it accounts for 30% S&P 500 profits. Because the companies, when you look at the weightings, it's a lot bigger than that. So now they have decent balance sheets. They raise money, whether through bonds or whatever. And a lot of those bonds are going to pay later on. They have cash on the balance sheets. They were supposed to use this for buybacks. Amazingly, we're not seeing buybacks. Buybacks are supposed to be crazy strong. These stocks are down 30%, 20%, 50%. Some of them, if you look at Netflix and Meta, they're not buying. Why aren't they buying back stock last quarter? Why? Because they're looking at the current environment going, holy shit, we're in a lot of trouble here. Earnings are going to crash, and we need to make sure our balance sheets are strong. This way, we'll come out the other side one of the strongest players. So, those are two catalysts right there that you were supposed to use to buy stocks. Now, for those of you who don't understand the earnings picture and the PE ratios, which is fine. This is our job to explain it to you. It's price to earnings. So when you see a stock come down 20%, it doesn't necessarily mean that it's cheaper. It actually could be more expensive. And a stock rises by 100% year over year, and it can actually be cheaper than when it rose 100% because earnings absolutely surged. It's all about the earnings numbers. And let's talk about that because, and it started to go on here, but this is important, guys. So you look at the S&P 500, the PE ratio, right? Not forward, but trailing. It's been over 18 every year since 2016. And you have the bears saying, well, since 2016, to 2021, right? Not even this year, 2021. It's been over 18. And we've had a lot of bears saying, you got to sell the market. It's terrible. The average is usually 15. And most of those years, it's been over 20. But we've never had zero interest rates, right? Which promotes more money coming into stocks. And if you look at the earnings growth from 2016, what do we have? We had 10% 16, 16% in 2017, 20% 2018. 2019 was 6%. 2020 COVID was down 30%, but then immediately we rebounded 110% earnings growth in 2021. And then 54% earnings growth in 2021, right? So we saw 100%, 10% earnings growth, and that was towards the end of 2021. So if you take those numbers, right? I'm throwing a lot of numbers at you. I'm going to condense them. Here's what you need to know. The annual earning per share growth is 25%. When you account, even you look at the 30% loss in 2020, since 2016. And you're looking at that for the past 7 years. And when you see the 25% annual earnings growth, the average PE ratio was 24 times. So at 24 times, you're not really that expensive because you're growing earnings at that 25% annual rate, which includes that big number, right? But still, even if you're growing earnings at 20%, which is more in line, you're looking at it close to that earnings per share number, where the 25 times earnings, the average multiple, and you're looking at 25% annual earnings growth. So you're not really expensive. Right now, again, earnings growing 25%. Earnings declined last year, ex energy, 4%. They're probably going to be down next year as well with all these revisions, fewer buybacks, the rising dollar. I mean, you're seeing this. Maybe they're able to cut back enough where their earnings are going to be okay, but you're going to see sales come down incredibly. Based on earnings declining this year and next year, our PE should be in the single digits. Because, again, those earnings per share, these estimates assume that the dollar would fall, but it wouldn't be, again, the dollar will fall a little bit off this, but it's still going higher and higher. And the fact that the Fed's raising rates means it's probably going to still go higher because that's going to hurt every other country. And they're going to continue to flock into dollar safety. So the dollar's probably going to continue to go higher. So when you're seeing stocks come down 20% from here, and you're thinking like, wow, they are cheap. They are much, much more expensive now with earnings not growing. And that's what you have to realize, because the current conditions of the market, what Powell is saying is he wants unemployment to go higher. He's going to aggressively raise rates from here while housing's basically shut down. Semis are warning, industrials are warning, retailers are warning for lower profits. Auto companies are starting to warn. These higher rates are going to crush the world economies, meaning the dollar's going to go higher, moving much, much higher from here. I mean, under these conditions, how do you see stocks going higher over the next 6 to 12 months?
Very difficult.
I'm not saying you can't buy some of the dividend players and things like that, but you're creating a scenario that's promoting tons of money to come out of this market. And we're not even close. We're not even close. I wish I could listen. I run a service where people pay me to give them stock ideas and stuff. And I'm telling you that right now, if you're looking to buy equities, again, doing this for 30 years, what are the catalysts here? When you have the Fed, the catalysts, remember, the last 10 years pre-COVID, people were saying, well, you're going to buy stocks, you're going to sell off, they're going to sell off, they're going to sell off. The catalyst was you had the Fed at zero interest rates, buying bonds, fund the money with system, and don't be an idiot and put your money into anything else other than equity markets, investments, housing, assets, and things like that. Forget about cash. Now it's totally the opposite. So by saying that you want unemployment to go higher, you're raising rates, and you're going to make the U.S. dollar automatically go higher, those conditions, if you look back at history, zero. The market doesn't go up. Stocks don't go up under those conditions. And that's what scares me.
Well, it is frightening. Powell is pulling forward Halloween, Frank. He's trying to do his best boogeyman thing, and it's working. I get your point. I like the breakdown of the sectors and things. Turning back to energy real quick, the wild thing there is that the energy sector, I believe I was reading earlier this week from the Wall Street Journal, still trades at like 8 times earnings. It's still very cheap. Why is that cheap? Well, it's because people are projected out in the future. We're transitioning away from oil. Oil demand will decrease over time. Therefore, it's okay for the sector to trade cheap right now. I totally disagree with that. That's one of the shopping list and areas you should be in, paying attention to, following, or at least scaling into for a lot of numerous different reasons. But I would say to stick to what's working. Look at energy, look at different things, chemicals. If we go through this long, drawn-out period, you and I were talking the other day about an interview with Palantir and Stanley Druckenmiller, not the other way. I butchered that hedge fund's name. But he was talking about, hey, what if we go through a long, pertained period of sideways? I think from 1966 to 82, the Dow Industrial Average was basically between 600 and 1,000 points, basically flat. The S&P went up on average, I think, 6.5%, but inflation was that. So you're looking at a terrible situation. Even if that's the case, we'll still find ideas. I mean, people, and I know you're not telling people to panic, but you're being honest. Right now, again, from our position in the business and everything, the right thing to do is to tell people what's going on and why you should be nervous. However, you should always keep stacking cash, keep to your plan of savings and all that, because there will be a better time to enter into everything. But there's a great article we'll talk about next week or something, Frank, but Oxy Petroleum with Buffett. There's a great article in the Wall Street Journal from a week or so ago about what the CEO went through with battling with Carl Icahn, hedge fund, big stake, to Buffett and all that kind of stuff. My point is that, and I know you're not saying everything's going down. In the short term, it may, because it's going to be hard to fight the Fed, but that doesn't mean that you shouldn't keep having cash on the sidelines for the next opportunity, because it will happen. Unfortunately, it just looks like it's going to be more weighted towards the end of half year or early into 2023 at earliest.
And that's the thing that I think that's going back and forth with people, what I'm listening to. I like to listen to CNBC and I'll watch Fox Business and just gauge sentiment from, what a lot of these people are saying. I mean, if the dollar is going to go higher, right? It's going to go higher. You're raising rates, and if you look at the debt situation across the world, it's horrible, and people are going to flock to the dollar even more. So it's going to continue to go higher. What does that mean? Good luck for gold. Good luck for gold. And I could say good luck for oil, because oil almost never goes up during a recession. Almost never. I mean, when I'm looking at this, and here's the deal, where you're looking long-term, stocks always go higher. They do. They always go higher. But there's certain periods where it's crazy. Now, I'm not saying that stock's going to go down for a year and a half, but I am saying that we are going to see a steep decline from here. And I'm hoping it's quicker rather than later. And if we could see a 30% decline in stocks next month in October, and the Fed starts lowering rates by February, March, or we could see this being a long, drawn-out recession that's basically already started, and stocks just grinding 20, 30% lower from here over the next 6 to 9 months. Either way, it's hard to see a scenario where stocks aren't going to fall. And when they fall, it's going to be because of profits. And you're going to see profits drying up. And the Fed's going to be like, okay, wait, let's stop looking at the CPI. And we have to be careful here. And that's when you'll see the opportunity to come in and really invest. But it's just a time frame. Mm-hmm. There's no way we're going to keep interest rates well over 4%. But it's not over 4%. Looking at over 4.25% for the entire year next year. Think about that. We're at 3. Look at what's happened in the last 6 months. Well,
and there's a lot of inflation data that's going to be coming out for the rest of the year. We'll get different readings and things like that. And then, to your point, going into next year, it's easy to say that everything will continue to get worse. It's just hard to magnify and quantify that right now.
And it is. But, just when I look at this and what I was saying about the PE, I mean, the PE ratio was high, but I felt like, for those who argue you should sell stocks because the PE ratio is high, you have to look at growth. That's everything when it comes to valuation. And you're shutting off growth. You're shutting off. China's shut off right now. You're looking at Europe shut off right now. You're raising rates aggressively right now. You saw in 6 months, I've never seen the housing market correct that quickly. And it took a while. People are like, well, Frank, what about the credit crisis? It was correcting in 2007. You look at when, Countrywide, there was a lot of mortgage companies that went under in early 2007, and we didn't see it to 2008, which was like, a year and a half, 2 years, and boom, you really saw everything hit. This is 6 months. That's how fast you raise rates 6 months. That's how quickly you destroyed the biggest growth engine for our GDP. All right, this is the biggest growth engine for consumer spending. I mean, when it comes to housing, it's a major component of everything that you purchase within a house. So you look at furniture companies, all this, appliances are warning. All these companies are going to warn. And not only that, it's, we assuming that the dollar was going to be, come down a little bit. Remember, 70% of profits from the largest companies that make up the most weighting, which are technology companies, comes from overseas. So the dollar is going to crush these guys. That's why they're all announcing layoffs. Facebook right now, too. Same thing. Just said, we're going to see cost reductions of 10%. You're going to see it across the board. Google said it. Microsoft said it a little bit. 1%. You're going to see it more and more and more, right? Even with Netflix. But it also assumed companies are going to buy back a lot of their stock, and they're not buying it back right now because they're worried about the future and higher interest rates and saying, let's, hunker down and have this cash on the sidelines, because if we make it out the other end, those are going to be the strongest companies. You're going to be able to buy so many good names who are highly leveraged for pennies on the dollar. That's what technologies do. They didn't do that too much during the big, tech bubble, right? But they've learned. That's why they have the best balance sheets and the strongest balance sheets since then, because the ones that survived, a lot of those became trillion-dollar companies, 3 or 4 of them. So they also assume, these earnings are assuming, Daniel, that they're assuming the backlog of business for these companies is guaranteed. You need to shave minimum 20% off every company that reports backlogs. This is every semiconductor company, every industrial company, auto companies. This is like, okay, we're putting down money and this is what we're going to do with our orders. I mean, listen, Boeing had 5,500 MAX planes before the crash, and then you had COVID, right? They had 2 crashes and they had to pull back on the MAX planes. And then I think it was a few months later, 6 months later, you saw, COVID, right? So, but they had 5,500 planes. Now they have last time I looked, it was 1,200, and they're building it up a little bit, 1,500, right? So the backlog of business was always included in Boeing's valuation. So when you're looking at a backlog of business, people are canceling. I just canceled one of my projects from my house. I was getting a screen enclosure that they would basically charge me 2x or 3x higher than anyone I've ever heard of in my entire life. And I'm like, okay. And, I agreed to it 6 months ago. And then we were talking about it. And we're like, we're still like, okay. And now we're finally at that stage where, okay, are we going to build this thing? And price went up a little bit more. And I told them, I said, nope, I don't want it. And they're like, well, yeah. And that's them building it in January, February. And that's how their backlog is. But I cancel my order because I know I'm going to get this thing for half the price they're quoting me for 6 months later, because these guys are going to be dying for business. No one's building houses. Very few people building houses. So think about that across the board, where how many people who said that they were going to do something, and it's not like I locked in or paid them. It was just, that's the later stage of my house. And I said, okay, this is what we're going to do. This sounds good. And now that we came down and signed a contract, I said, no, I didn't go against the contract or anything. I said, you know what? I'm going to wait. I'm not paying this much for a screen enclosure. You're out of your mind. I won't even tell you how much, because you're gonna laugh when I tell you. I'll tell you. They want me to pay $90,000. $90,000 for a screen enclosure over my pool. This thing should be costing $30,000 tops, $35,000. That's what they were quoting me at. And everyone I went to were like, we can't do it for 2 years. Now they're going to be doing it in 6 months. I'm like, okay, I'll take my chances now because the housing market is frozen. How many people are going to see that and do the same thing?
Right. Yeah.
Not just through housing, but the backlog of business. If you look at some of these guys reporting like $3 to $10 billion in backlogs, if you look at semiconductors, large ones, you got to assume 20% of that business is going to be gone. That's why they're seeing all of a sudden it was the biggest boom ever in semiconductors to we have a massive glut. Because you're seeing orders get canceled, and that's going to result in even lower earnings. So in this environment of lower earnings, and Powell raising rates here, it's difficult to see, the equity market. If you have small caps that are, which mostly they're leaving to the U.S. and certain growth areas that you might see, but you're going to be able to find some pockets. But man, the oil thesis, I think you have to throw out the window. I know you're bullish on oil. I could be wrong on that, but it's continuing to come down. How's that going to go up in a global recession? Who's building? Yes, we're taking some strategic oil reserves. We see that, and maybe it's going to result in a quick pop. But again, usually oil does very, very well in a booming economy. Mm-hmm. When we see a global recession, it usually comes down. And we're not we're super cheap on oil prices here. They're pretty high historically, or average historically right now. So we've seen 130, 190, but could they go down to 50? Absolutely. Could they go down to 70? Absolutely. Or 65, whatever. But even gold as well. When I'm looking at these sectors along and how are they going to see growth in their industries, it's very difficult to see. I mean, he's literally shutting off the entire world economy right now, and it's very, very scary. I just don't see a scenario where you're going to see the returns on these stocks where you're looking at names like NVIDIA still trading at 25 times full whatever earnings, right? Yeah, Disney as well, 30 times earnings. Like, how are these guys going to meet those expectations with the growth coming down tremendously? Where, we should be trading maybe 12 times forward earnings tops. And, that means we still have a ways to come down, which is pretty scary.
Absolutely. Real quick on your buyback thing. As an investor, it's painful and it's aggravating at the time. But if sentiment and the future looks bleak or grim or as a slowdown going into this, then managers are smart to wait and buy back because, like you said, they can announce buybacks, authorize them, But when they act, Buffett has done great over his career talking about this. As a CEO and a manager, your one of your most important jobs is capital allocation. If you are a CEO and you think tougher times are ahead, it is smart for you to authorize buybacks, wait, and start buying back shares at lower prices. That's what you want to see. You a lot of times they're just automatic buybacks to help with earnings per share and all that kind of stuff. You don't need to worry about that. The point is that it is good to see a lot of cash on the sidelines and ready. And one quick note here to cover your point well, Frank, is there's a quick note from Canaccord Genuity, and they were talking about the decline in June of this year, okay, in the S&P 500. It represented the 14th time the S&P dropped at least 19% since 1960, okay? In all prior instances, the 2-year note peaked before the S&P made the low. Said another way, if the market did bottom and we have, we'll somehow not go lower, it would be the first time in 60 plus years the S&P bottomed after that big of a drop, before 2-year rates peaked. Mm-hmm. To your point, it's just the short-term outlook.
Those are going higher, right?
The short-term, yeah, exactly.
4.1 now, right? So
exactly. It's not peaked is the point. Yeah. So could it happen? Yes. The percentages are very small. It's not a great soundbite or this isn't the best speech to give, to rally bull markets, but this is what you need to pay attention to. The easy path forward is lower, like your point. But that's a great stat. Hey, if we had seen the bottom now, it's the first time in 60 years that this has happened. The market's bottom before yields. Just understand what you're going into to make sure you're building cash.
It's very cloudy now.
It's exactly.
Extremely cloudy.
That's okay. You go through periods like this, but
think it would be
that's where we're at.
Yeah, you think it would be more certainty, but even what they said yesterday makes it much more cloudy for me than it is, because I just can't see that. You totally changed your stance as Powell, saying this is transitory with 0% interest rates. This is transitory, everything you learn, and now you raise rates by the fastest amount in 40 years, and now all of a sudden it's not even close to being transitory. It's here forever. It's a total about face, and now everything that he studied, everything that he's done, he's going back on everything. Maybe it transitory could have been 18 months instead of 6 months, right? And not saying that 0% interest rates maybe we go higher and higher on inflation, but you've raised rates. You're seeing it being controlled in a lot of different areas where it's not out of control right now, but you're still like pushing through like nothing has happened. Like we're not seeing the decline in copper and lumber, the housing market, like I said, the velocity of money. It's just it's coming out of the system. You're seeing it. You're seeing corporate profits come down. They're going to come down sharply now. It's going to be a lot worse than what he's saying in terms of pain. The good news is on the other side, I think this is going to happen a lot quicker than he believes. I think we're probably going to be lowering rates in March or April after we raise rates considerably this year, because we're going to see an absolute collapse in the markets. And I think when you see that and they do an about face, it's going to be an amazing, unbelievable buying opportunity. But for now, listen, you have to play defense. You have to. We've been saying this about our product, or learn about buying puts. Jenny is again, I've tried to push that down your throats as much as you can in November when the Fed did the about face and said, this is the time. Buy this newsletter. This is going to make you money, because it bets against stocks, against sectors. And Jenny is fantastic about doing that. And it's option related where you're not shorting, so you can only lose as much as you put up. And she's been killing it, and she's still going to kill it. So, I know it's options and people get turned off by it and they're like, they don't want it. You need to have protection on your portfolio going over the next 3 to 6 months. We said that from November. And look where the markets are. We're saying it right now. You have to be very, very, very careful. If you hedge your portfolio, you want to be invested in the market long term, because we know stocks go up and up, but there's times when you want to hedge yourself, in times where the Fed, it has a gigantic spotlight in your face saying, I'm raising rates. I'm going to force the unemployment rate to go higher, and the dollar is going to surge from here, which means it's virtually impossible for stocks to go higher. He's saying that to you. That's what he's saying. Okay, so we're going to see stocks go lower no matter what. It's just the degree of how fast it's going to come, where it creates the buying opportunity, and that's what you want to prepare for. But you have to be able to hedge your portfolio. We have a product that does that. If you don't want to purchase a product, learn about buying puts. It's very, very important to hedge your portfolio. That's the easiest way to do it. You can do it through your brokerage firm. And again, I know most people aren't going to do it, which is fine, but you really need to do it. I know nobody's going to do it because they're not going to do it, right? They just want to buy stocks.
It happens. That's okay. But they should check her out. She's brilliant, and that's an awesome product. So I'm
not even promoting it, and I'm not putting it at a discount because I discounted it before. It's not going to be at a discount anymore. But I'm just saying it's amazing how if you're trying to help people in a certain way, but there's a little bit of a learning curve there. learn it. You don't have to purchase the product. You don't have to do anything, but learn it. Learn how to hedge your portfolio. You can go on Google. You could spend a couple of hours reading and stuff like that and just try it little by little. Again, you're only going to lose the amount of money you put up, but I'd focus on companies with the biggest backlogs because those backlogs are going to be cut by at least 20%, maybe 40% for some of these names, as you're going to see a huge cancellation of orders over the next 3 to 6 months. And you're seeing it now. You're seeing it now. That's why a lot of these companies are warning. So, just be careful out there. It's going to be difficult to find opportunities, but let's see. Maybe you see some of these stocks sell off much, much more, and they go down to 4 or 5 times earnings, 6 times earnings, and it makes sense. But in a market right now, it's going to be very difficult where you're going to see a lot of stocks sell off a lot more from here, and we're going to be on the lookout for some names and be very, very careful, at least over the next 3 to 4 months as the Fed just goes crazy and raise rates, basically with their hands over their eyes.
Yeah.
Regardless of what they see.
Cruising blindfold, but it's okay. We'll find great opportunities. So stay tuned here to Wall Street Unplugged, Frank. That's easy.
No, I'm not saying not to listen to me anymore.
No, I know.
Listen to me.
I know.
Don't stay tuned and cancel your product. But, I'm just being real with you.
Yeah, that's good.
Like this market, I've never seen a Fed this aggressive right now. And again, interest rates, I feel like are controlled. They're not going, they're not out of control like they were last year. So, right now you've done a pretty good job. I think going forward, it's going to be one of the worst jobs we see. It's going to be much worse than when you said it was transitory, and you're going to go down as the worst Fed chair by far in the history of the United States since we've been hiring you. So it will be interesting. And again, like you said, we'll find ideas for you. We'll find little pockets. We're going to see stocks sell off much more than others. Some stocks in biotech are going to be trading below cash balance, which makes sense. Their net cash on the balance sheets. That's what we're going to see. And we're going to be, and long term, it's fantastic. You like to see these markets. That's when you make the most money, but you just have to be very, very careful here. And hopefully that message, I think, came across. What do you think?
Yeah, I don't think you came across bullish. I think people understand where you're coming from. Send us your thoughts and theses at Daniel at CurzioResearch.com.
Okay. Oh, me, Frank
I
at
beat you to
CurzioResearch.com. You did beat me to it. Oh, that's great. You did. What is it, Daniel? You said Daniel at CurzioResearch.com. So no, guys, really appreciate support. I'm sure I'm going to get lots of questions and comments from this podcast. The reason why I didn't recommend any stocks in some of the newsletters, I just wanted to hold and see if the Fed was really was serious about really super aggressively raising rates from here. It looks like they are, so we're going to adjust the portfolios accordingly, and try to make some money for you and hunker down. This way, we have great buying opportunities in the future. So, questions, comments, FrankCurzioResearch.com. Really appreciate all the support, and I'll see you guys next week. Take care.